My name is Derek Hathaway. I am part of the University of Toledo team. The most important lesson I learned would probably be teamwork. We had to coordinate a lot for the paper and the presentation. It took a lot to get everything together perfectly like we did. We had a lot of struggles, but we spent a lot of time going over everything to make sure it's just the way we like it. Once again, I'd probably have to say the biggest challenge again was teamwork, trying to get everybody be on the same level, operate at the same time, knowing what they want, what they were doing, when they need to do it. All of those things added together to make a much better presentation than just showing up and hoping for the best, yes. Definitely. We went over every aspect of the company, which, from my experience, what major analysts do as well. We had to present that, although it was to a board of judges instead of to a board of directors or a committee or an individual. It is the same concept. We had to analyze and present what we found. I think it gave me a lot of real-world experience. Like I said, it is very similar to the real-life experience, so it did help me realize what I'm actually trying to become, how I can face my future, what I need to do to prepare for my future, and how I would react in these situations. Good morning, we are the University of Toledo team. My name is Derek Hathaway.
Jinzhen Li.
Leo Z.
Yu.
Today we're presenting our analysis of Kellogg's. Kellogg's is a well-established company with low risk and positive future growth aspects. Based on our strong fundamental valuation, we concluded a 12-month target price of $69.48. From this, we strongly recommend Kellogg's as a buy. Before we get too far into Kellogg's, however, we want to talk about the consumer staples industry sector. Consumer staples sector can be divided out into three different industries: food and staples retailing, food, beverage, and tobacco, and household and personal products. We also included three main characteristics of the consumer staples sector: relatively low-priced items, stable revenue, and is an overall defensive sector, as you can see by the graph.
Here are some highlights of market data of the Kellogg. During our valuation period, the Kellogg was traded at $60.89 with market capitalization of around $22 billion. The dividend yield of the Kellogg was to 2.92%. And you know the Kellogg was founded in 1906, which manufactures and markets the cereals and the convenience food. Currently, the Kellogg is the leader of the packaged food company in the world. Recently, the Kellogg requires Pringles to expand their international snack markets. Also, they are implementing the Project K to increase the efficiency and effectiveness. The Kellogg company's layout was composed of two parts: international part and the US market part, which are differentiated by regions and product types. According to the third quarter report of 2013, you can see the U.S. is the largest market of 50% of total sales and over 60% of the operating income. That means the Kellogg still have the huge room to increase their international market.
We developed this graph based on Porter's 5 forces. From this, we concluded that Kellogg's is within an extremely competitive industry. However, Kellogg's has a competitive advantage with strong brand recognition.
We divided the Kellogg's potential risk in 4 different parts, and we treat operational risk as a kind of internal risk, and we treat market risk, economic risk, and political risk as a kind of external risk. And here's our risk metric analysis. As you can see, the probability increased from left to right And the impact differs from the top to bottom. And the highest impact risk we consider include the losing large retailer customers like Walmart, the supply chain disruption, and the increased price of the input. However, we think the possibility of this kind of risk happen is relatively low. And the highest possibility risk we consider is the product liability, like product recall. However, we think the impact of that one is only medium. So overall, we think that Kilos is a low-risk company which can be treated as a kind of defensive stocks.
Pringle acquisition is considered one of the most important growth opportunities. Pringle is a brand of potato and wheat-based stackable snack chips. It's well known by its unique design, also innovative cans. So such acquisition not only provide the new innovation platform in flavor, packaging, and form to Kellogg, but also provide premium position in leading brand awareness internationally. So we believe Pringle is a brand's strong fit the existing Kellogg snack platform and objective, which is become the leading players in the snack industries. So with Pringle's strong brand awareness, brand recognition, brand loyalty, we strongly believe Kellogg has much higher potential in the key emerging markets.
Recently, Kellogg's has announced a 4-year effectiveness and efficiency initiative called Project K. Project K is designed to create annual savings of $425 to $475 million by 2018, while also increasing investments within core business and emerging and developing markets. On January 10th, Kellogg's announced that they will be building a new snacks production plant within Malaysia as part of Project K. This also goes along with 2 of Kellogg's 4 main business strategies of becoming a major snack player and building on their emerging markets footprint.
We also believe that Kilos has much more projects related to global expansion. And here's something we would like to mention. Kilos shift its headquarters from Sydney to Singapore, and in this way, Asia Pacific headquarters from Sydney to Singapore. In this way, it will help it to expand its Asia market. And in order to satisfy its increasing demand of Pringles in Europe, Middle East, and Africa, Kilos will introduce 3 product lines in Europe. We also believe that Kilos is a company can generate much more cash flows than its major competitors. And this can be proved by the uptrend growth in both dividend and cash flow per share. And here is our first part valuation, relative analysis. As you can see, Kilos is an excellent company in the industry. Its low PE shows that it is undervalued stocks, and its high ROE shows that it can provide higher return on equity than the industry average. So overall, all this stuff can support our conclusion. Kilos is a value stock and worth to buy.
We also observed that Kellogg's dividend payment per share does not have volatile change in the past 10 years. So we are convinced that dividend discount model is the most appropriate discount cash flow model to value Kellogg's company. So we took retention ratio, profit margin, asset turnover, and financial leverage into account to calculate the short-term growth rate, 9.53%. And we also implied the market Kellogg stock price by Gordon's growth model to calculate 3.72% terminal growth rate. So we believe this number is very conservative compared to a 5% growth for the 5% dividend growth rate on Kellogg's historical past 10 years data. So we also conservatively expect the dividend growth rate will decrease from 9.53% to 3.72% in the next 5 years. So based on these conservative assumptions, we still got a higher target price, $74.27, which generate 22% capital gain.
We believe companies' value is tied to companies' earning. And we also treat PE ratio as a good indicator for companies' future growth. So we use the current PE, history average PE, and forward PE to calculate our average PE. And we times our estimated earning per share to get our target price, which is 69.63. In this way, we calculate our total return, which is 14.4%.
We also took Bloomberg analysts' recommendation into account, and we applied equal weight for each method because we believe each method will involve certain level of risk. So we reached a 12-month target price $69.48 with a total return 16.91%, including dividend yield 2.81%. So we conduct Monte Carlo simulation, and we treat terminal growth rate as a random variable because we believe such future variable is much harder to predict and high level uncertainties. And also it constitutes the largest portion of our future cash flows. So we assume that terminal growth rate is normally distributed with a mean 3.72% and 0.95% standard deviations. So the result shows us 67% buy possibility, 32% hold, only 1% for sell. So that result once again supports our recommendation, strong buy.
In conclusion, we've explained how Kellogg's is a well-established company and with low risks. We've also discussed some great positive future projects and our strong fundamental valuation. From this, we concluded that Kellogg's is an undervalued stock, and we strongly recommend it as a buy.
Yes.
Thank you for your time, and we will now be taking any questions.
Go back to the slide on the weighted average target price. What is the ANR? What is that?
Bloomberg analyst recommendation.
Okay, so that's average of
The
what
consensus
Bloomberg-
form, yeah, it's
so
a
that's
consensus.
Their consensus
Yes.
target price.
Yes.
And why did you weigh that more than,
Actually,
slightly more than?
well, actually, it's supposed to be equal weight just because of
Yeah.
rounding, yeah.
But, yeah, it
Yeah.
just strikes me that you probably want to put more weight on it.
Okay.
Your
Sorry.
opinion.
Yes, yeah. Just rounding problem.
Going back to your dividend discount model.
Yes.
You have a growth rate in there.
Yes.
Was it? (9.53%). The last dividend increases that we've seen have averaged between, I think, 4% and 6%.
That's true. So because
So why is that so much higher?
because we believe, because we talk about our investment thesis, such as expansion, acquisition from the Pringle, and also we talk about Asian, they concentrate on emerging markets, because we believe they still kind of expanding new market in the emerging market, especially China, and they try to increase the cereal, they try to introduce cereal into these new markets. So we believe in the short term, and in the short-term future, definitely it will increase in their cash flow to the firm and also their earnings.
And so that's going to result in them increasing their dividend? Or, I mean, I'm
Definitely.
struggling to put this together, because they've also got a lot of debt that they took on from the Pringles acquisition, so I'm thinking in their cash flow priorities,
Yes.
a lot of it's going to be paying down debt.
That's
may
right.
result in
So-
less growth in the dividend.
Yes, so that's why we will conduct the relative analysis. Even though they have high financial leverage, but they are still a strong profit margin and free cash flow generated within the industry. So even though we know they have a higher level of debt, that we still believe they're going to benefit their shareholders. I mean, in fact, in the last year, they just purchased back the shares from the equity holders. So probably it's future potential.
Any concern in this relative analysis where the industry is growing at 10%, they're growing at 4%, so maintaining, if you look at a peg for a PE or price to book, they are using leverage to get the profit margin, operating margin, but any concern relative to their overall growth of the industry?
Overall, yeah, actually, we consider about that. Still, once again, so that's historical data. Historical data doesn't mean anything for the future. So with this positive investment thesis or investment project, we definitely see is a future growth. But it's very hard to predict the future. But still, we put on this statistic just for their.
And we also think due to it has higher financial leverage, as you can see, that means from the positive side, you can see that this company do really have some good project to do. So that's the reason why we think the growth rate we used is really conservative growth rate. So we think the real growth rate may be much higher than what we estimate. And also for the sales growth, because Pringle is the fourth largest snacks brand in the world. So after Pringle acquired this one, and after it used cereal and Pringle to expand its Asia market, we believe the sales growth will be much higher than this one, even much higher than the industry average in the future.
What's the biggest risk you see out there that will make you change your rating?
Can we go to the slides of the risk part?
Yes.
I'm sorry, can you repeat your?
Yeah, what's your biggest concern, biggest risk you see out there that may change your recommendation? Not delivering on cost savings on that project, difficulty penetrating emerging market there.
Okay.
What do you see as the biggest risk that could affect changing your recommendation?
Okay. Well, first, I need to say that again, Kilos is absolutely a low-risk company. This can be seen from our risk metric. And the highest impact risk, as we mentioned in there, only have a very low probability to happen because, it's have a diversified supply chain and from our Portals 5 process analysis, that the possibility of increased price of input is really low. And the low single large retailer, maybe the possibility of this one is low too, because like Walmart, they still rely on Kilos. It's the #1 brand on cereal. However, for the product liability, because it has in the history, event, it do has a product recall, and I think we have one graph for the big event one, and you can see. After the recall happened, the stock price do not really change that much. So it seems that this company do have lots of experience, and investors still have enough confidence to this company, even that kind of high probability risk happened. So totally we think if we do need to mention one risk, maybe influence our decision, is that if Kilos really can let its product really accept by Asia market. Because now we know that in order to let product really suitable for Asia market, it has already changed its R&D center in Singapore, and to let it tasty much more suitable for Asia's people, especially its major target price, China. And if that is successful, we believe that its future growth and potential revenue will be huge. Yes.
Can you talk a little bit about leverage? Company is highly leveraged. Can you talk about the structure of the debt, how they financed Pringles by debt, but what is the structure of that debt, and are you concerned about any risks surrounding the potential of interest rates backing up?
Okay, maybe we too can answer this question.
Sure.
Well, first, from my part is that from this you can see that Kilos' total debt to capital is higher than its major competitor, right? And as you can see from our risk metrics, the interest rate we only put in the median side, like a median prosperity and median impact. For the median impact, a median prosperity is because until now there are many uncertain steps for interest rate. We all know that U.S. maybe decline its QE program in the future, so interest rate maybe go up in the future, and we also, but Federal Reserve ties the interest rate to the unemployment rate, and also because people think that until now U.S. economic and stock market is still not very stable, so the possibility of interest go up and very up is really slow, and so many uncertain stuff in here. So the possibility of increase of interest rate only give them a median possibility. For the median impact is because Kilos use many long-term contract swap to hedge this kind of risk. So in this way, we think the impact of the increased interest rate is only median. And we also believe good company with good project, that kind of high leverage is not that much risk.
Questions on your model. The growth rates you're using seem fairly small relative to, where we've been, and, you're talking about growth in Asia and emerging markets. You got 2.62% in 2014, you got 3.32% in 2015.
Yes.
What's driving that growth?
Because as I said, future is unpredictable. We try to be very conservative for this company's performance. And once again, so based on that logic, that's why we conduct the Monte Carlo. Monte Carlo is basically a randomly draw 10,000 iteration to see what happens for the future. So based on that's our logic. Try to be conservative.
How, and I don't see on the model the EPS numbers that you have, but there's some good growth in net income. How much of that growth in net income is based on Project K? And what is your assessment of the probability of them being successful with Project K?
Well, Project K, we try to, Project K basically is increasing efficiency and effectiveness. So we are mainly focused on the cost control for the Project K. So maybe you will see a slow growth rate in the cost, but on the huge market net income growth is came from the positive project. Also, the acquisition from Pringles.
My last question is, you talk about Asia, Pacific, and emerging markets driving the growth in earnings.
Mm-hmm.
The chart you showed earlier showed that I think it was 12% of earnings were driven by those markets and 15% of sales. So it seems like those are lower margin markets.
That's true.
How do you reconcile that?
Okay, first of all, the low percentage came from the currency risk. So Kellogg's use the currency swap to control that, try to hedge their currency position as the first point. The second one, as we said, emerging market have totally different cultural background compared to Westerns. So we don't know if the series really fit to the market because it's a brand new market. So we still try, in our valuation, we still try to be very conservative for these emerging markets, especially for different culture backgrounds.
And also, based on some of our information we get, well, Kilo used to, trying to put their product directly to Asia market like China, but because so many difference in eating habits, so it wasn't that successful. But we know that recently it joint venture with a Singapore company, Wilmar International Limited, and they get together trying to use Wilmar Limited. Wilmar International Limited, which is a Singapore company which have a much more supply chain network and they know more about Chinese or Asian markets taste habits. So in this way, we believe in the future the sales of Kellogg's in Asia will be grows up. And also Chinese middle class consumption is going up. And in the maybe next 5 years, China will be the largest consumption country about food and beverage. That is a good opportunity.
Thank you.
Thank you very much.
Okay, thank you.